People are constantly searching for a crystal ball. They want a secret mechanism to predict the future of the financial markets. Let me tell you a fundamental truth about wealth. Anyone who promises you absolute certainty is merely selling you a comfortable lie. The market is a complex machine, driven by human greed and fear. However, you do not need magic to conquer it. You only need a system to tilt the mathematical odds in your favor. This is not about guessing. This is about calculated control. When you purchase a stock, you are not buying a lottery ticket. You are acquiring a fraction of a living, breathing corporation. You become a partial owner of that enterprise. The ultimate objective is to select companies that inherently increase in value over time. This allows your capital to multiply without requiring your physical labor. Most individuals approach this game entirely blind. They gamble their money based on temporary emotions or fleeting rumors. That is the exact path to financial ruin. True control comes from understanding the hidden mechanics beneath the surface. There are two primary philosophies when attempting to decode market movements. The first is technical analysis, which involves scrutinizing charts and mathematical patterns. Day traders obsess over these graphs, hoping to anticipate short-term fluctuations. They believe the geometry of past prices will reveal the future. My approach is entirely different and deliberately simple. I do not engage in the chaos of daily margin trading or volatile options. I am a long-term strategist, which means I focus exclusively on fundamental analysis. I look at the absolute financial reality, the leadership quality, and the psychological power of the brand. Relying on a single company is an unnecessary risk. Imagine placing your entire life savings into one solitary container. If that specific corporation fails, your wealth evaporates instantly. The intelligent alternative is to utilize index funds. An index fund spreads your capital across hundreds of different companies simultaneously. If one enterprise collapses, your overall portfolio remains secure and continues to grow. A prime example is tracking the top 500 public companies in the United States. This method provides an impenetrable foundation for your wealth. Once this foundation is built, you can begin the calculated game of selecting individual assets. Before investing a single cent into a specific business, you must examine the raw numbers. We call this quantitative analysis. The numbers never lie, and they reveal the true health of any organization. You must begin with the balance sheet. Its sole purpose is to balance what the company owns against what it owes. Assets are divided into immediate cash resources and long-term physical properties. Non-tangible assets are also crucial, like a brand name that commands unquestioning loyalty from generations of consumers. Liabilities represent the immediate debt the company must repay within 12 months. There is a ruthless but highly effective calculation to determine if a company will survive. You simply divide the total current assets by the total current liabilities. The resulting number must always be greater than 1. For instance, if a major technology firm has a ratio of 1.4, they are perfectly safe. It means they can eliminate all their short-term debt with ease and still have capital remaining. If a company fails this basic mathematical test, I eliminate them from my consideration immediately. There is no room for emotional attachment when dealing with investments. The next document of absolute importance is the income statement. This reveals the actual profitability of the operation. At the very top, you have the total revenue, which is every single dollar brought in by the business. At the bottom, you find the net income, which is the money left over after the reality of expenses sets in. Every business has mandatory costs of operation, like raw materials, but they also have controllable expenses, such as the salaries they choose to pay their workforce. Subtracting these costs from the revenue reveals the operating income. To measure true financial health, divide the operating income by the total revenue, then multiply by 100. I demand a minimum return of 15% to even consider an investment. Finally, you must look at the statement of cash flow. The concept is exceptionally straightforward. You must verify that the company is generating an increasing amount of free cash year after year. A massive warning sign is a corporation that has negative cash flow but continues to pay dividends to keep investors artificially happy. That is a collapsing structure, and it will eventually run out of money. Once the mathematics are verified, you must analyze the psychological aspects of the business. We refer to this as qualitative analysis. The most potent weapon a company can possess is total brand recognition. When an enterprise becomes a household name, it commands immense consumer trust. They shape our culture and create entirely new global markets. The second factor is understanding the deceptive nature of the news. Social media hype and public rumors frequently manipulate the masses into buying at the highest possible price. The masses are easily influenced, and they usually lose. There is an ancient rule of wealth: buy the rumor and sell the news. When an investment becomes the primary topic of conversation among ordinary people, the intelligent investor prepares to exit. I witnessed this exact phenomenon during the technology boom of the late 1990s. Everyone believed the internet was a guaranteed path to infinite riches. They were eventually proven right about the technology, but hopelessly wrong about the timing. When the bubble finally burst, countless individuals lost 90% of their wealth. Only a few resilient giants survived that storm. Hype is the enemy of sustainable growth. The future of any corporation relies heavily on the psychological stability of its leadership. A single statement from a powerful executive can instantly inflate or destroy the value of their stock. You must identify visionary leaders who are actively constructing the future, such as those advancing renewable energy or artificial intelligence. But predicting the perfect moment to purchase these assets is an impossible task. Therefore, you eliminate the need to predict. You use a strategy called dollar cost averaging. You invest a fixed amount of money on a consistent schedule, completely ignoring the current price. By purchasing consistently over time, you automatically buy more shares when the price crashes and fewer when it peaks. When the market panics and the masses begin selling their assets in terror, the calculated investor sees an opportunity. A collapsing market is simply a global discount on exceptional companies. You must detach your emotions from the screen. You must embrace the cold logic of the numbers. Control your psychology, manage your risk, and let time do the heavy lifting. The financial markets are a mechanism for transferring wealth from the impatient to the patient.